Hello and welcome to my Smart Money, where we discuss everything about money, earning money, growing your investments, protecting it, and managing your debt. Everything money. And today we're going to be talking about the flow chart. How should you prioritize your money? And you may ask why this is important. This is important because it helps you, channel your money to the right place at the right time, maximizing what your income is. It helps you manage your day-to-day cash flow to fulfill your financial obligations. Here's a personal income spending flow chart. And the first thing you want to do is pay your fixed expenses once your salary has been paid and see how best you can reduce this from the budget. We would have a link to the budget down below. You might want to download it, or if you have something already, look to see how best you can reduce that. Right after that, you want to make provision for taxes if that's applicable to you, either as an entrepreneur or a small business owner. You want to put whatever taxes you'll be paying at the end of the year into a separate account so it's much easier for you to pay out when it's time. Next comes you making minimum payments on your loans. Whatever loans you have, your credit card, make the minimum payments if that's applicable to you. And if sincerely all you can afford is a minimum payment every single month, then that is an indicator that you need to look to increase your income, because your expenses would always meet up with your income if you do not look for a way to reduce it or to increase your income. Then you want to build an emergency fund of at least a month expenses or about $2,000, whichever one is higher, because that would be your 911 when it's time you need some escape, right? That will be your 911 when you need help, right? That's your 911 money. You want to have it aside so you don't easily fall back into debt and then accumulate so much interest over time. Next, you want to consider if your employer has RRSP employee match. Let's take, for example, your employer says if you put in $200 every month, it would be matched with a 20% increase. So, what you need to do is just put the maximum amount of $200 so you can maximize the match that your employer would be giving to you, right? So, nothing more. Just put that 200 just to maximize the match. After that, you want to consider if you have high interest debt. Anything more than 10% is generally considered as high interest. So if you do, if that's a yes, you use either the avalanche or snowball method. The avalanche method is tackling the debt with the highest interest rate first, while the snowball method looks at the smallest amount and then tackles that, gets it out of the way, and moves to the next. So if you want to consider any of that, please feel free to. You also want to consider if you have dependents who rely on you, you have parents, you have children, you have siblings, you have anyone that relies on you for their daily living. If anything happens to you, God forbid, how will they survive? If you're in that kind of a situation, then you want to consider getting a life insurance. And for that, you need to speak to someone. I can also help, to guide you on the best one to get depending on what you can afford. So, if you do not have dependents, you want to consider increasing your emergency funds to 3 to 6 months instead of the 1 month that we previously discussed. And the next question you want to ask yourself is, do you have other interest debt aside mortgage? If that's a yes, you want to use the avalanche or snowball method to continue paying down your debts. You want to get your debt out of the way. Like we said previously, anything more than 10% is very high. And anything aside your mortgage, you want to get it out of the way as soon as you can so you can really be debt free and begin to enjoy some financial freedom. The next question you want to ask is, do you have kids that are interested in college or would be interested in going to the college? If yes, you want to contribute to the RESP, that's the Registered Education Savings Plan, and that is matched by the government. And that is matched up to 20% on the first $2,005 that you contribute, up to a total lifetime amount of $50,000 per child, if that answer is a yes. And if that is a no, you want to evaluate the merits of your TFSA, your RRSP, and your universal life insurance for retirement planning. But that is unique to your own personal situation. So you might want to book a consultation, to discuss that further. You want to consider if you have a short-term goal, for example, a car or house purchase. If you do, you want to start saving towards that. So ensure you save it in a high interest savings account so you can maximize whatever interest that comes on that. If the goal is less than 2 to 3 years, so you can actually have the cash as liquid, but it's still invested in some way. And that's going to offer you the highest interest rate that you can get considering the bank that you have it in. And if it is between 3 to 5 years, you might want to invest them in conservative funds. And if the answer is a no, you want to max out your registered account first. For example, your TFSA, which is totally tax free. TFSA in itself, it is good to note at this time that it is not an investment in itself. It's just a vehicle. So whatever money you have in your TFSA, ensure it is properly invested. Same thing applies to your RRSP and same applies to your life insurance if you want to use that as your retirement plan for tax-free generational wealth transfer. And at this point, you have so much more options. Give yourself a pat at the back if you have been able to solve all of this flowchart successfully. You have sorted all of your debts. You don't have any high interest loans. You have more to invest than, to pay loans. At this point, you can actually begin to knock out your goals. Save more towards your short-term goals, pursue them, and you can actually plan to retire early. Who says you have to be so old before you retire? These days, 30s, 40s, retire. I mean, if you put it in the plan, you can work towards it. And I would also encourage you to look into diversifying into taxable investments if you have maxed out all of your registered investments. And that could include owning businesses, investing in other people's businesses, considering angel investing, real estate crowdfunding. I mean, there are so many out there. You want to really diversify. And you may ask why it's important to diversify. It's just a way to reduce your chances of experiencing large losses. You can keep your investments, grow your investments, and protect them. To summarize it, you want to ensure your credit card and your loans, especially high interest, are all paid. You have an emergency fund. You've taken care of your dependents if you have any. You also have investments and you're debt free, and you begin to achieve your short term and your long term goals. And until we see again in the next video, keep on succeeding. Bye for now.